Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer and today we are going to be analyzing Conagra stock, ticker CAG. This one came in by request down in the comment section of one of my other videos a while back, and I am finally getting around to making this one. If you have a request of a stock you'd like me to analyze, just drop it down in the comments. If it's a stock that's in the S&P 500, I post those videos on YouTube for free and on Patreon as well. If it's a stock that's not in the S&P 500, I post those on Patreon at the $5 a month tier level, so you can pretty much ask any stock that you'd like me to analyze, as long as it uses kind of my three main public strategies. If it uses a different strategy, often I'll have some sort of commentary on the stock. And then if you want kind of the full service, it's over on Seeking Alpha. And if you join on Patreon, you can get a big discount to the full Cyclical Investors Club service over there, where I have all these spreadsheets and everything that I show everybody here, chat room, and a lot of other things, my whole portfolio and everything like that. So those links will all be down in the description. I'll also be using Fast Graphs in this video. I have a 25% off affiliate link down in the description for that, so just use that link with the code if you are interested in a Fast Graph subscription. I've been using it for over 5 years now, so I kind of use it in my own special way. I don't necessarily use it in the same way that other people do, but that's one of the great things. You can use those tools for whatever kind of strategies that you develop and whatever kind of data that you think is important. And so that's what I will be doing today with Conagra. All right. As always, this is not individual investing advice. This is just how I analyze stocks. Let's get into this one. So I always like to start by looking at the historical earnings pattern, which is this dark green shaded area here in the fast graph. It goes back about 20 years. And they've gone through some relatively choppy earnings periods, with kind of slower growth, with occasional downturn, but nothing super deep. But the overall trend here is, I would call it slow growth with moderate cyclicality to some degree. If we just look at the basic numbers here, let's shorten it to 2024. So about 2.5% earnings growth, which is very slow. Now the fast graph measures it but it is positive, I'll say. It measures from this point all the way up to this point, basically, and then kind of assumes that earnings are growing at a steady rate during that time, the 2.46% rate. But in reality, some years are lower, some years are higher, and in fact, this year is lower than last year's rate, earnings. So what I like to do is take each year, and I do have a video on the channel where I kind of show how I do this, but I like to go year by year, and that way I can account for these down years along the way. If there is some choppiness, usually that results in a more conservative earnings growth rate, but usually it's not too much more conservative. Because I like to think of these as collected earnings if you own the business that you could keep for yourself. And if there's occasionally these big down years, well, those are years you wouldn't have been able to keep as much of the earnings. And so I like to bake that into the earnings growth rate estimate, basically. Let's see. Other than that, I think we can just go on with the normal analysis here. So I like to take a more recent time frame, just in case things are going better or worse. This won't have a normal recession back like we had in 2008, but these guys weren't super affected by that recession anyway. And we kind of have a drawdown period here that's similar to that one. So I don't feel like we need to be super extra conservative due to recessions and credit cycles and things. So let's just look at this period here. So Fast Graphs has this coming in at a little under 2% earnings growth. I'm going to look at my estimate. So these guys didn't buy back a lot of shares in a steady way. They bought back some, but then they issued a bunch. So probably for M&A. So let's just quickly take a look at what I have. So I'm at 1.75. That's very similar to the fast graph, so not much difference. There wasn't anything to adjust for buybacks, and really all I adjusted for were these down years. And so we're pretty similar at that earnings growth rate. Now I would kind of stop right here and say that earnings growth rate is lower than the inflation that we've had during this time period. That would immediately pretty much turn me off to the stock. To me, one of the main reasons I would hold a stock is because it can raise their prices to their customers at a rate greater than inflation. So I want inflation protection with this longer medium-term stocks that I buy. Otherwise, bonds become probably more attractive because you're at least going to get your principal back. Something could go wrong with these guys. I haven't looked at the price lately, but I mean, if you bought up here and you've been holding since, how many years is that? Like 7 years or something? Your average return is down plus inflation. You're losing maybe like 5% a year. So that's the type of thing you don't want to have happen. You might as well have just bought a treasury, right? And so that's one of the reasons why I have like a certain amount of growth that I want, and these guys don't quite meet it. But another issue is, and they aren't quite negative on this, but I like to look at the 3-year revenue trend. So this is cumulative 3-year revenues, and they are positive, so that's good. If they were negative, this would be a pretty easy automatic sell for me, unless there was like some good reason for it. So this is right on the borderline. I mean, we consider this as 3 years. That's 1% a year. It's actually very much in line with the earnings growth rate. So it does give you some confirmation there that these things are all kind of saying the same thing. Very slow growth at a rate lower than inflation. So that would be another warning sign. Not totally red, but pretty close. So, I think the mistake that a person could make, well, let's also just look at another issue. So when I include the debt that they have, which the long-term debt is about 42%, I like to look at the difference between the market cap and the enterprise value, which is about 63% for these guys, and then adjust the stock price accordingly. So I just did this, so I think I remembered it correctly, but yeah, 63% adjustment. So instead of a $29 stock price, I would treat it as a $48 stock to account for those extra obligations a person would have to have if they went and actually bought this business, like bought the whole business. That makes this valuation look not as good. So like a 5.43 earnings yield. Let me do the PE real quick. That's more like an 18.4 PE instead of the 1130 that it looks like, which it is in the fast graph, but it just doesn't account for the debt, right? So when you first look at this, you think, oh, that's a cheap PE, even if they weren't growing very much, maybe it would still be worth buying it. But then when you take into the debt into account, like the debt and other obligations, you're looking at a 18.5 PE. All right, well, now that doesn't look like nearly as attractive, right? So that would be the first thing that I would look at. Also, and so this is another thing, like people ask me, I made a whole video on why I don't really use the mean reversion anymore. But this might be a good example too, where you want to look at a few other things besides just the mean reversion, because maybe these levels weren't the same back, maybe this ratio wasn't the same back, 7 years ago or something. So if you did that and let's see, see if I can do this right. I haven't done it for a while. Yeah, so if you're like, hey, over the next year, if this reverts to the mean 14 PE, I stand to make 40 something percent. That could be pretty enticing, but were earnings growing at the same rate back then as they are now? I don't know. Maybe they're probably similar, maybe a little worse, but was the debt level the same? So were interest rates the same? Well, interest rates definitely were not the same. So now you can get a 5.3% yield on short-term treasuries with no risk. So it just makes these stock. I'm not sure what the dividend here is. So that's even more than their dividend yield. So this is, you could think of it as a 4.7% risky dividend versus a 5.3% guaranteed dividend with no risk, right? So that doesn't look so great unless there was some like growth driver, some improvement that you thought was coming. I don't really do that sort of thing normally unless I really feel strongly about it. I go mostly on what they've done historically. So even though this stock is down, let's see how much it's down. 30, we'll call it 30%. A person might say, well, definitely it's better valued perhaps, but we see earnings are falling this year. That's why the stock is down. Earnings were rising 17% in the particular year before, which is another reason why you don't necessarily want to extrapolate out 1 year's worth of earnings like Wall Street does. So if you looked at this, what was it trading at? Yeah, so 15 PE plus whatever that debt was, because they're saying, oh, they're growing 17%. They're going to keep growing 17% forever. Well, no, the next year earnings fell. And now it's back in line with where it was before when you start averaging the 3-year return. Like we looked at the 3-year revenue. So you have what, 16% worth of earnings losses, a 17% gain, and you're like 1%, right? That's right where we were. So that doesn't always work, but that's the baseline that I always like to start with. So yeah, it basically doesn't look, it's not as cheap as it looks. So when we actually run the numbers on this, using this 1.75 growth rate, using that debt adjusted PE, which is going to be more like 18.4, the earnings yield's 5.43. When we run the numbers on that over a 10-year period and see what sort of earnings CAGR we would get, making those adjustments, it's 4.8%. This is actually a little worse than the average S&P 500 stock. Now, that's just basically the way to think about it. Like 5.5 is percent 10-year estimated CAGR is kind of where the market is at, like the S&P 500 is at on average. Now, if we adjusted this earnings growth rate to see what analysts think, so analysts are actually thinking 3% next year, then 5%. So they're thinking 4% earnings growth. So probably if I change this to 4%, we're going to be around that 5. I haven't checked this, so we'll see if it's actually true. We'll probably be closer to that market 5.5% value, 5.3, right? So pretty close. So the market thinks 4% earnings growth going forward. That would put it right at the market average. I'm more conservative with the 1.75. So to me, this number would say don't buy and be cautious. This number would say don't buy and be cautious. And this number would say sell. And these are very close to sell. So to me, this is, over the medium term, this is probably a sell. But we've seen that historically it bounces around in this range here. So, I might have said the same thing back in 2018, and then, a couple years later, it has a couple good years together, and it puts together an 86% return. So that's possible, but that's kind of picking the exact bottom and the top, I mean, even if you got somewhere down, let's just say you got near the bottom. Let's say you bought here, right? You hit a double bottom. You're like, it looks cheap. It's a similar PE to where it's at now. Now you're only looking at like a 7%, and 4 of that is inflation. So you would have done okay, but it's not great, and that's probably one of the more optimistic scenarios that could happen, would be what I would say. So yeah, to me, if a person owned it already, I would be watching it closely, and I wouldn't be buying it. And maybe if you found a different business that you liked just the business better than this one, maybe consider swapping it out if a person owned it. So those would be my thoughts. If you found this useful, hit the subscribe button. If you have a request, put it in the comment section. I'll make a video for you. And I'll see everybody later. Bye.